Hi, Richard here on Thursday the 22nd of September. Two charts here. One is the Dow on the left, the other is the S&P 500 on the right. I wanted to show you first the Dow and the similarities of what's occurring against the S&P. You will remember going way back to August 2009, we've had this rising trend line which is quite significant and has been tested as support on a number of occasions. You can see it broke through on the flash crash, retraced, and then finally came through only to become resistance in June this year. And we've tested it 1, 2, and now for the third time. So the key question is what's likely to occur here. But this spike high is very significant, including the fact that we've got a little bit of indecision here, and also volume is starting to drop off. Putting it alongside the S&P 500 though, we can get a more accurate reading in terms of the technicals, and you'll have to look through these numbers, but they're important because we've got three sets of probability occurring in terms of the potential for resistance. The first is the rising trend line, which has the same characteristic. It's not a perfect science, but there is a little bit of movement in here, but you can see that these reversal candles are quite apparent. Now, what will it mean? Will it be a correction or will it be a continuation of the bear? Well, that's yet to unfold. However, when we put a Fibonacci retracement on, which measures the April 2010 high to the July low, we can see that we've come up against this red line, which is the 61.8% retracement. In other words, it has hit 61.8%. The market's telling us this is significant. We shouldn't underestimate it. It is smack against this trend line. The other thing that's important is the nature of this overlapping correction, which has been, in general parlance, a sideways trend, but this is very much soup and very difficult to trade. However, what we do know is that this is now a 333, so we can see that we've got this three-wave correction here, which is the first part of the correction. We then come into the second part of the correction, which is an ABC down, and then this ending diagonal up. So the ending diagonals are always terminal, and they generally retrace to where the origin was. In this case, it deemed that the origin was about the bottom of wave 2. Often they go back all the way to here. But then we've come up in this zigzag from here. So this is a 3-wave down and a 5-wave up. So strictly speaking, that should be the end of the second wave of the continuation of the bear market. Now, again, as I mentioned on the other chart, what's likely to occur, what it may not occur, this is just a possibility of two options. So when we assess where the market might go, we can see that there could be a potential retracement back towards this 200 moving average, and in the event that that holds up, we may possibly see a blast through occur, and that would take the market to new highs. So that would clearly invalidate all of this mess that's going on in here, but if it goes through that way, then certainly we want to be long. But I can bet that all traders around the world that are watching this chart will be going short from here on in. They will be looking with tight risk management, with a stop over the top of that spike high. They'd be looking to go short here, and what they will do in the event that there is significant support is stop and reverse as opposed to stop and exit. So they would stop and reverse and then take this ride higher, because these are great technical opportunities in terms of trading these markets, but strictly speaking, we could well see a continuation of the bear market push down here. So therefore there's short opportunity in the short term. We'll be assessing it. We'll be looking to see whether it actually reverses and blasts through. That would take us higher up to this sort of 1200, or take out the April high mark towards the end of this year. As we look at the Australian market, and this is it, we also know that there is significant resistance, and if I just bunch that up, it will help to see it a bit. Here is the April high, and indeed we've got the Fibonacci retracement, which gives us this mark here at 4,680 or 681. you can see that the telling factor was that when the Dow broke through on Wednesday night or Tuesday night, pushed up high, it reversed and turned around. The next day the Aussie market did not follow on, and that was very telling. And in fact, as we expand that chart out, you can see that this is a doji reversal signal. This is really telling us, it's giving a cue based on the 61.8% retracement, based on the triangular nature of the pattern, this 5 waves up and completion, that really it's looking to want to go lower. Indeed, the MACD is starting to fold over. However, that's not a done deal yet, that's for sure. So in the event that it did come off, we would look for first target around the 38.2% Fibonacci retracement from this high to here, target of 4,528. We'd be watching very carefully to see whether or not there is this stop and reverse type opportunity. The Australian dollar has really been a meteoric rise up. We can see that relative strength down here is overbought, and is looking to retest the underside of the relative strength index from this previous breakdown. But importantly, we've got 5 waves up here, so there's 1 down for 2. This is an extension of the third wave to 4 to 5 now, but it doesn't mean that the trend is over. The target is 9600 to 9650. It hit 9600, I think, no, not quite, 9680 overnight. It hasn't tested this line. It could in fact throw over this line, which would be a very good indication that there's some topping activity happening. This previous correction that I talked about in the past did not eventuate. You can see I left it on the chart to show you the type of angle that we'd see. The previous double top was just simply taken out. So this is in line with gold, of course. Australian dollar as a currency, as a commodity currency, has pushed higher in line with gold. That's what you'd expect. That's what the gold miners expect. Is that the two are correlated. In the event that you get higher metal prices, you should also see a higher Australian dollar. And indeed, for commodity exporters, in the event that we expected weaker commodity prices, then you would also have to look at hedging the Australian dollar for an export perspective. But here it is, 1291 was the target one. That's been in place for a week or more now. It hit 1290 and pulled back. That was based on a previous Fibonacci expansion from these two lines here. So up, stop, down, stop, and then that projects out to 1291. The next expansion takes us all the way back up to around sort of 1360 mark, but I'll make that more explicit depending on what happens from here. But even on the open of to morning's trade, you can see that there is activity which is continuing to sort of push up. So gold is definitely bullish. And just looking at a gold stock being Newcrest, this has been also a meteoric rise for this particular stock. We did show this chart some time ago. At the time I put a Fibonacci expansion on, which measured the low at $32 odd to the first 3-wave high, and then measured to the low. So up, stop, down, stop at 35. Project that out, and you can see that it's traded straight up to the 61 or the 1.618 expansion. That is 1.618 of this particular leg up. So quite accurate, hit it and has reversed.